Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over calculating taxable gifts. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. Again, it's free, it is 1 hour long, and we will teach you the key ingredients to passing the CPA exam. It's something you don't want to miss, and it will save you so much time struggling with your process. Go check it out. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it on the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Okay, here is question 1. Margaret decided to gift assets to her 2 nephews, Edward and Charles, in the current year. On April 15th, she gifted Edward $50,000 in cash. On September 20th, she gifted Charles a painting she had purchased for $20,000 years ago, which was valued at $80,000 on the date of the gift. What is the total amount of Margaret's taxable gifts for the year? Okay, so what of these amounts, and there's not too many numbers here, what is the amount of gift that will be taxed for her in the current year? So if you don't know how this works, that's okay. We're going to go ahead and go straight into the answer to start learning how this works. Okay, and the answer is $130,000. So that looks like it's the $50,000 of cash and the $80,000 fair market value. So let's read through this. When calculating taxable gifts for federal gift tax purposes, cash gifts are counted at their face value, so whatever amount of money you gave them, that is the taxable gift. And property gifts are counted at the fair market value on the date of the gift. Here, Margaret gifted $50,000 in cash, and the painting had a fair market value of $80,000, so added together, that gives you $130,000. So that's the basic gist of it right there. Of course, we're going to dive into multiple rules here, but the general idea is when you donate cash, that's what's taxable as a gift, and when you donate property, the fair market value of that property is what's taxable on the date of the gift. Okay, let's go ahead and go to the next question. Here is question 2. In the current year, Sarah made several gifts. She donated $30,000 to a qualifying charity and gave $5,000 to a local political organization. Additionally, Sarah paid $20,000 directly to a university for her grandson's tuition and $25,000 to her sister to cover medical bills. How much of Sarah's gifts are included in the taxable gifts for the year, considering the applicable exclusions for gift tax purposes? Okay, we haven't really learned what the exclusions are, so if you don't know how those work, that's okay, we're going to look at it. However, if you do have an idea, go ahead and pause the video, and when you're ready and done with the calculation, come back and we'll look at it together. Okay, and the answer is $25,000. So let's look at these exclusions. Under federal gift tax rules, certain types of gifts are excluded from being taxable, including gifts to qualifying charities, gifts to political organizations, tuition payments made directly to educational institutions on behalf of someone, and medical expenses paid directly to the medical institution on behalf of someone. So again, those two, very important distinction there. Tuition has to be paid straight to the institution, same with medical expenses. So as we look at Sarah's case, the charity, the political organization, those aren't included in gift taxation, and the tuition is also excluded because they paid it directly to the university. But the $25,000 that she gave to her sister to pay for the medical bills, well, she's now going to be taxed on that because she didn't pay it directly to the hospital, she paid it to her sister. And if you know anything about gift taxes, yes, there is an annual exclusion that we're going to talk about. We're not looking at that in this question, we're just looking at the total gifts that could be taxable. And again, that's the $25,000 here that she paid directly to her sister. All right, we learned a little bit more there. Let's go ahead and go to the next question. Okay, here is question 3. In the current year, John and his wife, Lisa, decided to use gift splitting for their gifts to their daughter, Emily. They jointly gifted $60,000 in cash. Additionally, John gifted Lisa a piece of artwork valued at $25,000 as an anniversary present. Lisa also gifts $30,000 in stock individually to her brother, Mark. Assume the annual gift tax exclusion per donor is $15,000. What is the total amount of John and Lisa's gifts that is subject to federal gift tax? All right, so obviously there's some more rules here that we don't know about. Again, if you have an idea of how this works, try to test yourself, pause the video, and do the calculation. But if you don't really know what any of this means, that's okay. We're going to look at the answer to learn how it works. Okay, and the answer is $45,000. So first off, there's the gift to the spouse, which is Lisa. The $25,000 piece of artwork that John gifted to Lisa is not taxable due to the unlimited marital deduction for gifts between spouses. This means it is entirely excluded from the taxable gifts. Okay, another rule there. Gifts to spouses, always excluded, no matter the amount. Okay, gift to Emily, and this is their daughter. The total joint gift to Emily from John and Lisa is $60,000. With gift splitting, each spouse is treated as having given half of the total gift. So $30,000 from John and $30,000 from Lisa. Each spouse can use their $15,000 annual exclusion, which means $30,000 of the $60,000 is covered by their combined exclusions. This leaves $30,000 of the gift to Emily as taxable. Now, one thing I want to point out there before I talk about gift splitting, this $15,000 annual exclusion is not the actual annual exclusion for the current year. I believe in 2024 it's $18,000, but the idea behind these videos is not to teach you the exact numbers most of the time. It's more to teach you the concept and make you aware of the different things that go into each calculation, even if the numbers change a little bit every year. So again, $15,000, and you're going to see this throughout the rest of the video, not the actual annual exclusion for the current year that you're in, but it is the exclusion that I'm using for this video for teaching purposes. Now, going to gift splitting, John and Lisa can basically count each of their individual exclusions, so $15,000 from John, $15,000 from Lisa, towards whatever gift they give if they consent to gift it jointly. So that basically allows married couples to double the annual exclusion for somebody they give gifts to. Now, for the gift that Lisa gave to her brother, she gave a gift of $30,000, and it stated specifically that she individually gifted it, or basically it was implying that she did not gift it jointly with her husband. So we only take her exclusion in this case, meaning that there wasn't gift splitting, so there's $15,000 of it that does count as a gift that can be taxed. So you add the $30,000 from Emily that wasn't excluded, and the $15,000 from Lisa's gift to Mark that also wasn't excluded, and that gives you $45,000 of gifts to be taxed this year. All right, let's go ahead and go to the next question. Okay, here is question 4. Robert purchased a vacation home for $200,000 and subsequently transferred the property into joint tenancy with his nephew Tom. Additionally, Robert and Tom opened a joint bank account with $50,000, which Robert funded entirely. During the year, Tom withdrew $20,000 from the account, and he was not required to repay Robert. What is the taxable amount of Robert's gifts for the year? Again, assuming the annual gift tax exclusion is $15,000. Okay, so this is another thing, another rule that we haven't learned yet. So again, if you have an idea of how this works, go ahead, pause the video, see if you can do the calculation. But if not, let's go ahead and dive straight into the answer to learn yet another rule about gifts. Okay, and the answer is $105,000. So let's read through this. So when it comes to joint tenancy in property, this is how it works. When Robert transferred the vacation home valued at $200,000 into joint tenancy, or basically they both own it, he made a gift of half the property's value to Tom. The gift is considered $100,000, half of the $200,000, which is subject to gift tax as it exceeds the annual exclusion and is not between spouses. And then as far as the joint bank account, the $20,000 that Tom withdrew from the joint bank account also represents a gift from Robert to Tom. Since Robert funded the account entirely and Tom is not required to repay the amount, the $20,000 is considered a gift in the year it was withdrawn. In total, the taxable gifts from Robert are half of the value of the vacation home and the $20,000 upon withdrawal. And there's no other exclusions that apply in this situation other than the annual exclusion. So we subtract the $15,000 from the $20,000 withdrawal, or you could technically subtract it from the $100,000, doesn't matter, leaving you with a total of $105,000 of taxable income. So this one is probably the most confusing or complicated that it can get. Just remember that if somebody owns something or buys something and then puts somebody else on the account or gives them ownership of it and the other person didn't have to pay for it, that can be considered a gift. All right, let's go ahead and go to the next question. Okay, here is question 5. At the beginning of the year, Thomas decides to assist his daughter Melissa in establishing her own business. He sells her a commercial property he owns valued at $300,000 for $200,000. Additionally, Thomas loans Melissa $100,000 to help with startup costs, interest-free and payable over 5 years. Assume the applicable federal rate, or AFR, for calculating imputed interest is 3% annually. What is the total amount of taxable gifts Thomas made in the year of these transactions before applying any exclusions? So we're not looking at the annual exclusion or anything here. We just want to know what of what he did during the year counts as a taxable gift. So again, this is something new. If you don't know how to do this, that's okay. We'll look at it. But if you have a general idea, go ahead and pause the video and do the calculation. And when you're ready, come back. We'll look at it together. Okay, and the answer was $103,000. So, for the sale of property below the fair market value, let's look at that. When Thomas sold the commercial property to Melissa for $100,000 less than its fair market value, this difference is considered a gift. Thus, $100,000 is the value of the gift due to the sale being below fair market value. And then for the interest-free loan, by providing an interest-free loan of $100,000, Thomas is also making a gift of the imputed interest each year the loan is outstanding, basically gifting her or making it so she doesn't have to pay the interest that she should be paying. The annual gift amount is calculated based on the applicable federal rate, which is 3% for this scenario. The imputed interest for the first year is $3,000. So the total taxable gift in the year of the transaction includes the $100,000, which was the difference in the property sale, and the imputed interest of $3,000. And if you'll notice, this is for related party transactions. So yeah, when it comes to related party transactions, if you sell something to somebody for less than its fair market value, or you give them a loan that has an interest rate that is below the applicable federal rate, those can trigger gifts as well that will be taxable. All right, we learned a ton of different rules about gift taxation in this video. Let's go ahead and do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice things that keep popping up throughout the questions that you're doing. These are topics or calculations or concepts that you've seen like 4 or 5 times and are obviously important according to your review course. So you take a second, think about it, and you write them down so that you know them for later. Let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics for the video. First, for gift valuation, gifted property is valued at its fair market value on the date of the gift, whereas cash gifts are valued at the amount given. Next, gifts made to political organizations, charities, educational institutions when paid directly for someone's tuition, and medical expenses paid directly to a medical institution for someone else are not considered taxable gifts. Also, there is an annual gift tax exclusion available per person, which can be doubled for married couples through gift splitting. Gifts between spouses are not subject to the gift tax due to the unlimited marital deduction. Also, when property is transferred into joint tenancy, a gift is considered made in the amount of half the property's at fair market value unless it is gifted to a spouse. And as far as related party transactions are concerned, providing interest-free loans or selling property below fair market value to related parties can result in imputed gifts calculated based on the interest that should have been charged or on the difference in value, respectively. So those are the pillar topics for this video, and I think we learned a lot. Thank you for watching. If you want to learn more, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. Again, it's 1 hour, it's free, and it will save you so much time struggling with your process. Make sure you go check it out. Also, if you liked this video, make sure to like it and leave a comment, and remember that if you become a Superfast CPA member, you will have access to the full 10-question video when we post it on the members forum so you can get more practice. Thank you for watching. I hope this was helpful, and I will see you in the next video.